that's the profit and loss in a nutshell, guys. Let's dive right into the balance sheet. How are they related? What is a balance sheet? What is it telling us? All right, I'm going to pull in a file in a minute. Give me 1 second here, please. So just prepare the balance sheet. All right. So here's, we have a balance sheet of a hypothetical company called XYZ123. And one thing you'll notice that balance sheets are as of a specific date, which means that it's different from profit and loss, where profit and loss exists for only 1 year. And every time that year comes to an end, that profit or net loss, either net income or net loss, moves, closes out. So there's actually an entry that's taking place that you don't see, that's closing out whatever that amount is. And it's moving that amount, that net income or net loss, over to our balance sheet. So let's see what that looks like on a balance sheet. And on a balance sheet, you'll notice your net income from that year is actually landing here. Now, again, a balance sheet is as of 12/31, which means that it's a snapshot that's the balance as of that date. Whereas a profit and loss really runs for a range, and it's really from beginning of the year to the end of the year, as an example, from January 1st to 12/31, and it exists for only that 1 year. Then it's closed out, moved over to a balance sheet where things continue to keep moving. Remember, a balance sheet is like a checkbook. In essence, it'll always have some sort of running balance. That's why they're calling it a balance sheet. So it'll never really, numbers here will never really disappear, because as long as there's always a recurring balance in one of these accounts, you're always going to have some number there. All right. What is a balance sheet in general? What does it consist of? What is it telling you? Very simple terms. And again, this would apply to an individual or a business. When you're dealing with a balance sheet, you have your assets, okay? You have your liabilities, and you have what we call owner's equity, or your net worth. Right? If you're a personal financial statement, then this would be owner's net worth. What are assets? Assets are anything that you own personally or your business. Those can be your bank accounts, assets like equipment, furniture. I mean, you name it, accounts receivable. There's so many different assets. If you own it, then it's your asset. All right. If I'm looking at right now these 4 walls and I own it, then that's my asset. If I have a desk, that's my asset. If I have a computer, that's an asset. All right, so that's just anything you own. All right, liabilities are anything you owe. All right, credit cards, notes payable, loans payable, very straightforward. It's people you owe money to, all right, institutions, whoever. All right, owner's equity is actually the net worth. It's what you're worth after you look at your assets less your liabilities will equal your owner's equity or your net worth. So if I have assets of $100,000, for example, and I have liabilities of minus 50,000, that would mean that I'm actually worth 50,000, right? I have to be worth $50,000. And again, this is gonna balance out. So my liabilities plus my owner's equity has to equal my assets, okay? And they do. Otherwise, the balance sheet wouldn't balance and all the accounting wouldn't work. The accounting is a double entry system. For every debit, there's an equal and opposing credit. All right, just keep that in mind. So it always has to balance out one way or another. That's why we use software like QuickBooks. Otherwise, there'd be errors. Now, when we're dealing with this formula, it can also be seen as assets plus liabilities equals owner's equity as well. So you can rearrange the formula using algebraic equations, but we don't have to do that here. We can just keep going with this content as is. All right, so that's basically a balance sheet. And now you understand why it's called a balance sheet, and you understand that it should balance and that it's carrying numbers into infinity as long as there's a running balance. And a great example of that would be like your bank account, right? So your bank account, if you have 50 bucks sitting in there, it's gonna sit there forever, right? It's gonna keep that balance on. The only thing that's gonna make that 50 bucks go away is the bank fees that they take every month for just keeping an open bank account. until that balance comes down to zero, or something's happening to it, basically, in a nutshell. All right, yeah, so for this for this example company, we have our current assets section, all right, and it's all highlighted in this color here, or it looks to be like some sort of off orange color. But yeah, these are all examples of assets, you know, so your bank accounts, you have all sorts of bank accounts, you know, same idea, same principle, you know, current assets is the parent account, your sub accounts are bank accounts, and then sub accounts would be PayPal, payroll, you know, account with your bank, and operating account with your bank, your total bank accounts. These are all your assets. These are things you own, right? Same with the receivables. It's money that people owe you. It's probably a good time now to talk about cash versus accrual basis of accounting as well. When we're dealing with accounts receivable, that's really an accrual basis of accounting. So when reading financial statements, I'd say also what's a very important thing to look at right away is to see if your company is on an accrual basis of accounting or on a cash basis of accounting, because some of these things like accounts payable and accounts receivable, if you run the report in QuickBooks and actually click the cash basis, reporting accounts payable and accounts receivable should disappear. Accounts payable and accounts receivable goes back to the accrual basis of accounting. It's saying that we're going to reflect costs when they really take place. That's true accounting, right? Because whenever we're doing reporting for accounting, we want our readers to be able to get good data. So again, what's the point? So they can get, they can make managerial decisions or just decisions to see which way to head with everything, right? So in order to do that well, you have to have a good representation of what's the true financial status as of a particular date and time. Right? I'm not talking about auditing or vouching for information and confirming the accuracy that these things actually exist. I'm not going to go into conversations about Crazy Eddie and stuff I learned in auditing class because that would just convolute everything way more. What I'm trying to say here is that true accounting will reflect everything on an as-is basis. So if I get a bill from my doctor or from my lawyer or whoever, and I haven't paid it yet, does that mean I don't owe the money? No, I still owe the money, right? So that's what an accounts payable is. It's something that is an accrued expense. It's something that hasn't left my bank account, but I already owe for it, much like a credit card. All right, very similar. And the same vice versa would apply for accounts receivable. It's money that I've billed, I've created an invoice, but I haven't gotten paid for my client yet. So should I include that in sales? Well, yes. I mean, if you want to do true reporting, you should definitely run your books on an accrual basis of accounting, but it would be a very complicated process because you're asking for an accountant to do a lot more work because we're trying to get all that data in to really show you what's the true financial picture at a certain particular snapshot in time. And without looking at things like accrual basis of accounting, which would be to bring in accounts receivable, accounts payable, prepaids, all these things that deal with accrual basis, we're basically not giving you anything much more than what's leaving and coming and going from your bank account, or what we call cash basis reporting. Cash basis reporting was actually something created by the tax authorities to make reporting for small business that much easier. So that way people didn't have to really go worry who owes me, what I owe, and this and that. Some things, by the way, overlap and they apply to both accrual and cash basis reporting. So inventory would be an example of that. But other than that, yeah, there's very specific items that are only going to go fit into one bucket or the other. And most people are on a cash basis of accounting. Some people need to be on accrual basis of accounting for tax purposes, and some will be by default because they're really large entities. But for most small business is typically on a cash basis. So it's just very simple. It's what you've spent versus what you, to a degree. I'm not going to say it's quite simple because it's really not. There's still a lot of tax laws that go into for cash basis that you want to understand. But this is going to go beyond the scope of what we're dealing with here. All right, so anyway, now that I've spoken a little bit about accrual basis of accounting and what that means, I hope that's helped you understand what to look out for as well right off the bat when you're picking up a balance sheet or a profit and loss. You want to see what's the reporting like. Is the report being run on an accrual basis of accounting, or is the report being run on a cash basis of accounting? What does it really mean? So again, preferentially, you would have accrual basis of accounting reporting going on, but not necessarily reporting for tax purposes. But again, whenever you're putting together an accrual set of books, you're asking for way more work, because now we have to look at cutoff dates and figure out what belongs into a certain time period and what doesn't belong in that time period. And we have to make these special adjustments. QuickBooks does have some built-in tools to help with it, but a lot of it's still very manual and needs to be handled by a professional that understands how everything works. Okay, so your total assets in this particular case, after we added up the security deposits and organizational costs and leasehold improvements and furniture and everything. So our total assets is $308,603.03. Then we can go into the next section, which deals with liabilities. And again, as I explained, it's just money that you owe people. And that could be your accounts payable, that could be your credit cards, that could be sales tax, payroll tax payable, what have you. And as long as you owe somebody money, okay, then that's a payable. All right, it's a liability. Now, equity is the other section. It's like your net worth. You know, you put in $1,000 towards your stock purchase. You have your retained earnings. You have what the shareholder contributed or what the shareholder distributed. And every year we plop in new income. This new income will eventually move from here. It'll move into your retained earnings. And this number will disappear as of 1/1/2022. And we'll start working on the 2022 profit and loss when 2022 comes to an end. We move the net income back into here to reflect it. And then come January 1 of 2023, that number flows into our retained earnings and it's being retained. That's the money that we're sitting on, right? That's our net worth. All right, so in this particular case, we have positive net worth. We actually, our assets are way greater than our total liabilities. So our company has a lot of good equity, and now it's actually worth something. And it has benefits for selling the business, and it has benefits for tax purposes. All right, guys. So again, very straightforward stuff here. I know we took up a little bit more than half an hour, but I think that this video will really bring some great information your way. Some of these things I don't think you'll be able to really find online, because I'm bringing you my personal experience from my professional life and giving you all those little secrets that most of the time you don't hear about on YouTube or even maybe at your accounting professional. So yeah, that's pretty much it. I hope that this helps. And again, one last thought. Yes, you can absolutely, I would definitely suggest to run numbers in a comparative fashion as we did with the P&L, where we're looking at, you have 2 years, so you can do the same thing when you're running a balance sheet. You can do a variance analysis and see how you're doing from there. So don't get in the habit of just looking at 1 year independently. Always look at your financial statements with another set of data from the past, so that way you can compare and contrast and see what's happening. All right, guys, if you ever have any questions about financial statements, how to read them, or anything that deals with accounting and tax, Freyman CPA has your number. We know all of this stuff day in and day out. That's what we do best here at Freyman CPA. Remember, our motto here is your success is our success all day, every day. Thank you and have a great one. We'll talk again soon.